Good afternoon, everyone. I'm Mark Nagel, and welcome to the 13th Annual Conference on Futures and Derivatives. For 11 years, we held this conference live and in person, and last year and this year, due to circumstances beyond our control, we've been forced to do a webinar. It's my fervent hope that next year we can all meet in person. We have a great program for you today. We will be presenting two panels, a regulatory panel and an enforcement panel, each lasting about 1 hour. There'll be a 5-minute break in between at approximately 2 o'clock Central. On the live event page that you're looking at below, there are pictures of each of our panelists. If you click on those pictures, you can see their full biographies. Each panel has prepared a great deal of written material to supplement their discussions. You will find links to the material just below the live screen. Today, we will be issuing CLE certificates. To qualify for CLE, you will need to write down a code number that runs across the bottom of the screen at approximately 20 minutes after the hour and approximately 40 minutes after the hour. Just below the live screen and in the email you received with login instructions, there is a CLE credit form. After the program, fill it out, return it with the CLE codes, and you will get a CLE certificate. There is also an evaluation form that we would encourage you to complete as well. If you have any questions during the program, there is a chat section to the right of the screen, and we will try to have our panelists answer your questions if time permits. So first, to our regulatory panel. We have Jennifer Sunu, Director of Compliance at the National Futures Association. And Jennifer, I'm proud to say, has been with this program since its inception 13 years ago. We have Andrew Vrabel, Managing Director and the Chief Regulatory Officer at the CME Group, and Renato Mariotti, Partner at the law firm of Thompson Coburn. Renato, let's get right into it.
Thank you, Mark. Well, we've got a great panel here today. Always enjoy speaking with Andrew and Jennifer. And obviously, like Mark, I definitely note the new circumstances we're all in. It's obvious that things have changed when we're meeting in this format. And there's certainly obvious changes that have happened in our industry. The trading floors, for example, are no longer filled with traders, and we're working from home more than some of us would like. But what I'm interested in asking our panel is, what has changed that we might not have noticed? And I'll start with Andrew. Andrew, what has changed at CME Group that maybe people who are listening and are watching don't know?
Well, thanks, Renato, and thanks, Mark, also for putting this together. Yeah, I think the most notable thing that's changed within CME, particularly the Market Regulation Department, it kind of relates to the office I'm sitting in right now. There's been enormous amount of senior leadership that took opportunities this year to retire. Starting with Greg Benbrook, retired earlier this year. I think many people are familiar with Greg. He's been involved in this conference, or have been involved in this conference for decades. And then shortly after Greg retired, Steve Schwartz, who was our head of enforcement, retired. Following Steve Schwartz, Tom Lasala, who is our chief regulatory officer, retired. And at the end of next month, Bob Snigowski, who had been our head of rules and regulatory outreach, will be retiring. So that's a lot of change up in senior leadership positions. I mean, the one good thing that we've done over the course of the years is had a pretty strong succession plan. So I succeeded Tom Lasala as the chief regulatory officer. Aaron Middleton will be succeeding Bob, or has succeeded Bob Snigowski as the new head of rules and regulatory outreach. Steve Schweitzer, who's on the next panel, succeeded Steve Schwartz as the head of enforcement. And then succeeding me is my former head of investigations role as Aaron Smith, who I think most everybody here has probably gotten a letter from Aaron at some point in their lives. So we come with a lot of bench strength, but no doubt there's been a lot of shakeup around here.
And Jennifer, what about at NFA? What changes have there been there that people may not be aware of?
Well, I think the biggest change, and luckily we haven't seen the retirements and things that they have had over at the CME. But the biggest change has been the way that we've been conducting the exams over the last 18 months. So we've had to switch to doing all of our exams virtually. And we've been taking another look at whether or not we should continue that practice, at least for some of the lower risk exams that we've been doing. Because we find that it's pretty efficient to do it that way. Firms tend to like that process somewhat, rather than having auditors showing up in their offices. So we are taking another look at whether we should expand that to doing it more often than we did before. We also are taking another look at our branch office definition, because we recognize that firms are also, a lot of those people are working from home and will probably continue, at least on a part-time basis, going forward. So that's one of the changes that we've recently done was we had a proposed rule that just got approved last week. It was effective last week. So we've now changed the definition of branch office so that it's no longer covering those people that are APs who are working from their homes, either on a full-time or a part-time basis, as long as they're not holding those offices out as a branch or a location of the firm, and as long as they're not meeting with customers at those locations. So that's been a big change for us as well, and one that I think a lot of the firms have been anxiously awaiting.
Absolutely. I could see that one having some pretty lasting impact, because it seems like the changes we've had in the world have changed the way that all of us have worked. One other thing I wonder, Andrew, is there any changes regarding surveillance on the CME side?
It's interesting. Kind of what Jennifer said. I mean, because of the pandemic, we've converted everything into being remote working. But that hasn't changed a whole lot, from the day to day. Historically, the majority of people that were conducting interviews of subjects of investigations have, for the last probably 7 or 8 years, were predominantly done over the telephone rather than in person. So that didn't change much. Our expectations on getting responses from firms has gone back to, I think, pre-pandemic levels. I think last year we gave a lot of leniency in terms of extensions and the types of information we were requesting, but that's really going back to pre-pandemic levels. Obviously, I think that when everybody started working remotely, including people that are handling customer orders last year, we did change a lot of our surveillance to look for customer types of abuses, front running or trading ahead, potential money pass activity, account transfer activity. So we widened thresholds and increased parameters pretty dramatically. Thankfully, we didn't see an increase in those types of violations. So over the course of time, we started to pare those back a little bit. They're still heightened compared to what they were pre-pandemic. Just because there is, I think, still an elevated level of risk when you have brokers who aren't under the same type of supervision that they were previously. But by and large, I mean, things seem to mostly be returning back to pre-pandemic, even though everyone is mostly still remote.
Now, Jennifer, we spoke about the change in definition for branch offices, but have there been any rule changes at NFA over the last year or two that people might not necessarily be aware of, or it's important for people to be aware of?
Yeah, so there's a couple that we've made effective just this last year. The first one is actually going to be effective tomorrow, and that's an interpretive notice on third-party vendors and third-party service providers. So we've always, had pretty strict interpretive notices and rules relating to supervision. This kind of codifies what firms should be doing if they're using a third-party service provider for some of their regulatory efforts. So it talks about making sure that they're doing a proper risk assessment to determine, the reputational risk or the logistical risk or the cybersecurity risk that comes with outsourcing some of your regulatory efforts. It talks about making sure that you're doing proper due diligence at the beginning, so that any third parties that you're using have the proper operations in order to be able to do whatever services you need them to do. And then it talks also about ongoing monitoring. So making sure that any reports that they're sending you, for example, seem to be accurate. And then also kind of taking a holistic view, every so often to make sure that the firm isn't having any issues, which might, lend itself to make, to see if they might no longer be in business soon, and you might have to find alternative arrangements. So as with most of our rules, it does require you to put procedures together, so written procedures that talk about all these different things. And we do obviously allow for flexibility. So depending on the firm's operations, firms can tailor the procedures to fit what their operations are and what they're doing for their outsourcing. So that's one main rule change that we've had. The other one that I wanted to briefly mention concerns CPOs. And so for years, we've had notice filing requirements that the commission had implemented for FCMs and IBs. We've now put in place some notice filing requirements for CPOs. So if it really centers around pools having financial distress. And the reason for that is that, whenever there were big market moves or other things happening in the industry that would lead us to be concerned about what's going on with our commodity pools, we would always have to kind of look through the information we had and try and figure out which of our, 1,000 or 2,000 CPOs that we have might be having a difficulty as a result of market moves or other issues. And so this allows us to get these notice filings and then work with the firms to handle any issues that they have as a result of any problems that they're having.
Well, now, Andrew, I know CME has had some significant rule changes, probably none more significant, at least to me, than a rule that is close to my heart, Rule 575. I spend a lot of my time counseling clients regarding Rule 75, giving trainings to employees, firm employees, and so forth. Can you help us understand those changes and other significant changes over this past year?
Sure. I mean, because the cadence and frequency of these conferences is so strange compared to normal years, it's hard to reflect on what we've actually talked about in these types of settings. But so I have to almost go back to like the middle of last year, and we made one significant update to Rule 575, where we separated some of the subsections in the rule itself, and then added more context in the rule advisory. But effectively, what we clarified in the rule is we said that it's a violation of Rule 575 to engage in conduct intentionally or recklessly that has the potential to disrupt the systems of the exchange. Now you think about that. That's a super broad rule, right? Conduct that has the potential to disrupt the systems of the exchange. So a lot of questions we got right after that came out was, well, how do I as a trader know what has the potential to disrupt your systems, right? And we appreciate that. The reality is that a lot of times, and even looking back at some of our prior cases that we've had, firms have known the type of conduct that has the potential to disrupt the systems of the exchange, either because they'd had prior engagements with our technology or operations staff, and our operations staff has advised them stop doing that because you have the potential to disrupt our systems, but they continue doing it. Other things, we have exhaustive technical resources on our website on acceptable practices. Other times, and I think this is what a lot of the modifications to the advisory relate to, are just practices engaged by some firms in order to avoid industry standardized protocols. And it's really like, it gets really deep into the details of network communications. But firms taking advantage of network protocol by restructuring order messages to gain very slight advantages in latency. And the firms appreciate that type of conduct could cause an issue to the exchange, either individually or if more people begin doing So we included several very detailed examples into the 575 MRANT to try to address that. We did a lot of outreach to participants that were engaged in activity that had that potential. But it is a significant change. One of the most significant components to it is that if you look back over the last 10 years worth of ATS malfunction cases, going back to one of the very first ones I worked on when I came to CME a long time ago against a firm called Infinium Capital Management, and they had an ATS that malfunctioned, and they knew that it was malfunctioning, but they continued to put it back into the market. So there you have an example of a firm that knew that they had an issue, but they chose to disregard that issue and put it back into the market, and it caused a market anomaly. So even back then, we brought that case under acts detrimental to the welfare of the exchange. Today, we could easily bring it under the new provision in 575 that says that the firm engaged in intentional or reckless conduct that had a potential to disrupt the systems of the exchange. So it's a new rule that actually encompasses a lot of activity that we've already brought actions on in the past. So that was the first change. We had to fast forward a year. So this is now in June and July of this year. We had some other I don't want to call them significant changes to 575, but there were ones that are worth noting. And the first one relates to some additions to 575, the MRAN, to include provisions that are consistent with the CPC's new electronic trading risk principles. The standard components of firms engaging in conduct that could trigger a review for market regulation under electronic trading risk principles. And I think there's been enough discussion on electronic trading risk principles, and the language that's in our rule is almost mirrors the language that ICE Futures US put into their rule. So there's a lot of consistency between the DCMs. The one other thing that we did when we made that change to 575 for electronic trading risk principles is a little bit more nuanced, but for some firms it can actually maybe a little bit more impactful. And there's a specific provision or a Q&A in 575 that talks about activity in pro rata markets, and pro rata markets is always interesting. And to appreciate, you kind of have to understand how the market works. In pro rata, the incoming aggressor orders distributed ratably to the resting orders in the order book based on each order's relevant size, their representative size. So the larger the order, the greatest proportion of the incoming aggressor order that order gets. So what it causes is firms enter very large orders, and they may enter multiple large orders. And what we saw, there was an event back in May where there was a very large trade that happened in one of the treasury products, and some of the liquidity providers that had very large orders in the order book began offsetting that risk almost immediately and very aggressively, and caused a fairly significant market move in that particular instrument. And so we added, and I shouldn't say added, we clarified in that particular Q&A related to pro rata markets that firms have to have the ability to take financial fill of the full order. That had always been there. But they have to be able to manage the risk attendant to fulfill without disrupting the market, which has always been in 575. It was covered by 575D for the last 7 years, however long it's been in existence. But we felt it necessary to add specifically into that pro rata section. So there are a lot of firms out there that have clients, or the firms themselves may be very active in pro rata markets. They need to be especially aware of that particular provision. And we may be sending inquiries, and we may already have sent inquiries to firms asking them how they intend to manage full fills without disrupting the market and offsetting that risk. And it's a pretty significant issue for some firms that post very large size.
Well, first of all, I do want to follow up on that, but before I do, I want to mention to everyone, in case you don't see it, the CLE code is running along the bottom. And so I want to make sure everyone gets their CLE credit, so please take special note of that. As the host, I've got to make sure I say that, the moderator here. I will say, as somebody who spent a lot of time reviewing 575, working with firms that are dealing with inquiries from your shop regarding 575, that the provisions that you talked about are at the very outset, Andrew, have been the source of, for a long time, a lot of discussion. I'll just say as some commentary that I've gotten so many questions over the years about the potential to disrupt the systems of the exchange and what that means. And so I would urge everyone in the audience to pay very careful attention to those MRANs. I have seen, and I can't talk more about it, but I have seen enforcement activity from CME in this area. I would not be surprised if there are cases coming out in this area in the near future. So it's very important to take a look at. A lot of people think of 575 merely as a anti-spoofing provision. It has some other important provisions in there, and it's important to pay close attention to those other provisions as well. I also do want to note, and obviously this is, I'm sure, going to be covered in more detail by the enforcement panel. There have been some important developments in disruptive trading practices more generally. And, that's something that I think we may want to discuss. I'll leave that open to either of you. If either of you want to talk about that, there's certainly been some developments beyond just the rules in your particular organization.
Yeah, well, I mean, Renata, I think you're pretty familiar with. I mean, it can't be a discussion on disruptive trading without talking about spoofing a lot. But there have been some significant actions still, for spoofing activity. I mean, you see, the criminal cases that came out in the jury verdicts that came out, in the middle of the summer. And what I think is notable about these, and I think everyone that's in the audience appreciates this, is how aged that activity is. And there are obvious reasons which Renata, it'd be interesting to hear your take on kind of the use of wire fraud statutes. But to the extent that the government is using statutes that have 10-year statutes of limitations, if you think about that in perspective, so we've been monitoring for spoofing for a very long time. But you could effectively take any spoofing case that we brought an action against in the last 10 years, and arguably it could be prosecuted by federal criminal authorities. And kind of the interesting takeaway, I think, is that we've certainly seen a decline in the big spoofing cases. Absolutely, without doubt. Like after the first several exchange actions for spoofing came out, and some of the larger CFTC and criminal cases came out on spoofing, there was a dramatic decline in the big spoofing cases. But we still have a fair number of the individual people located all around the world who are engaged in relatively smaller scale spoofing activity. So it hasn't gone away, but it's gone away from the big players for sure.
Yeah, I think in many ways that's a testament to the fact that, first of all, obviously the marketplace is listening to and to the guidance that's being given, but also to surveillance and enforcement. I will just say, in terms of takeaway, prior to this last year and then this year, there had not been a criminal jury trial conviction of spoofing since 2015, when I tried and won the Cassia case back when I was at the Justice Department. There was that initial win in the first spoofing trial, and then there was a couple very significant defeats. One in Flotron, which is not quite a spoofing case. It was charged differently along the lines of what you mentioned, is kind of an oddly charged case. It's a conspiracy case. And then the Thakar case that I had tried on the defense side, where it was a case that was brought against a non-trader. It was brought against a computer programmer, also sort of an unusual case. These last two cases that have been brought by DOJ that have resulted in wins, the last one, the prior one was a partial win, where they got a conviction on some counts, but not most. This last one, they got a conviction on almost all of the counts, if I understand it correctly, were both convictions for conduct that occurred in some cases pre-Dodd-Frank. So they were literally charging spoofing activity that occurred before Dodd-Frank. And I guess my reaction to that is that it's well established that spoofing can be convicted under the federal fraud statutes. And in fact, I brought fraud charges against Mr. Cassia in the first spoofing case, and he was convicted, and the Seventh Circuit upheld that conviction. What I would say is I did not bring in my former office, I'll be more broadly, did not bring charges for activity that occurred pre-Dodd-Frank. You could do that, but I would say, in my mind, it was an abuse of prosecutorial discretion to do so, in my opinion. I thought it was a very aggressive move to bring those cases at this point in time. But I think one thing that is clear is, first of all, that the government has, DOJ, the folks in Maine Justice have figured out how to try those cases, but also that communications matter. And in this last case, there were very significant communications that occurred that the defense really did not have an effective strategy to deal with. And maybe they couldn't. In other words, I think there may have been a sense that you could try to take any case to trial against the Justice Department in this area. And they tried, and then they realized, okay, the slam dunk cases, the DOJ can win the slam dunk cases in this area now. In any event, I think the broader point, though, the broader takeaway, I think, is an important one, which is these rules are still important. They're important for compliance. There's a lot of, from my perspective, there's a lot of surveillance and a lot of activity, not only from market reg, but from the commission and so forth in this area. But that doesn't necessarily mean that we're going to see those huge enforcement actions that we saw in the past with massive dollar amounts, and that's just because the industry is complying, and there's been a lot of important outreach and guidance that's been given. I don't want to talk any more about this because no one came here to hear me. They came here to hear from the two of you. And so let me go to Jennifer, because I have not been talking to you just in this minute here. And I'm interested in changes in your enforcement efforts and what have been new trends in your enforcement efforts over the last year or two. Can you give us a sense of that?
Sure. So you mentioned communications, and definitely that's something that we're seeing more and more, where we're taking disciplinary action against firms for not maintaining particularly their electronic communications, but also certain circumstances where they're not maintaining the phone records that they're required to maintain. And obviously, over COVID, a lot of firms got relief from having to maintain certain phone records, but there's really been no relief for the electronic communications, so emails, chats, text messages, all of that. And so, the main things I think that we've seen in that area relating to our enforcement efforts are firms that thought that they were maintaining records, but didn't do enough supervision to make sure that those were actually being maintained for the entire time period that they're required to maintain them, or not paying attention to brokers who were using cell phones or WhatsApp or things like that to communicate with customers. And so their firms should make sure that they know all the avenues that their brokers are using to communicate, and maintaining those records and ensuring that they're maintaining them for the entire required time period. And to check on that every so often to make sure that everything that's required to be maintained is actually up and running the way it should be. So that's one main area that we've seen with our regulatory efforts. And I expect that we'll see some more cases in the near future, in addition to the ones that we've just recently taken. I think another one that most firms would be interested in knowing about is that we just started taking cases relating to firms failing to have effective cybersecurity programs. So we had created a rule, an interpretive notice back in 2016. So it's now been 5 years that the rule's been in place. So at the beginning, we really tried to take an educational approach and make sure that firms had put together a program and that it contained everything that it was required to contain, and that they were doing training on it for their employees and doing annual reviews and making sure that it was, that any questions that firms had, that we were able to address those and make sure that their programs were robust enough. And so after about 5 years or so, we said, well, maybe it's time to take a little bit harder approach. And so we did start taking a look at firms who had been members for a while, for at least since the time that the INTERP had been in place, and either had, we've started with the ones where it was clear they had no program in place, or it was really, really deficient and hadn't really made much of an effort to try and put together something. And I know that there's a lot of firms out there who are on the smaller side and, might have been thinking, well, the INTERP allows for flexibility. And so we just assumed that meant that we didn't have to have a program. But all the firms are required to have a written program in place. So anyone who doesn't have one or thinks that maybe theirs doesn't cover everything that it needs to cover, I suggest that, they go back and take a look at the interpretive notice and really try and beef it up, because we will start, we'll continue to take actions as appropriate. Also, for any firms that maybe haven't had a written program in place, but have been taking appropriate measures for cybersecurity, they can make sure that kind of information gets documented, because we're going to be much more lenient with someone who has had all of these measures in place and maybe just didn't have a formal program written down. So any records that they can maintain that'll show that they were taking some steps will go a long way as far as whether or not we take disciplinary action. But those are two of the newer ones that we've seen more recently.
Yeah, Jennifer, just as a follow-up. Oh, I'm sorry. Mm-hmm.
I was going to say, one other interesting thing related to the NFA and CME is, I think a lot of people appreciate that CME has a good relationship with the CFTC, particularly on enforcement actions. But we also have a really strong relationship with the NFA. And if you go back to midsummer, you'll see a disciplinary action from CME and then a registration revocation action from the NFA against an AP named Peter George Antones, who was identified, I think, independently between the NFA and CME, but he orchestrated a scheme of submitting fictitious transfer requests, moving positions from his unfriendly clients into accounts of his friendly clients, to a tune where I think that the fraudulent allocations resulted in harm to some of his customers to almost $200,000. So it was an action where we took a significant enforcement action against George Antones. The NFA revoked his registration permanently, but you could see he's submitting fictitious transfer requests to his firm. So you go back to some of the the fraud provisions that you were talking about before. There's potential quadruple jeopardy there. The NFA, CME, the CFTC could take an action in theory. The DOJ could take an action in theory. So there is there's much more to the investigation and enforcement for a lot of these matters than just a single DCM or just the NFA.
That's interesting. I was going to ask you, Jennifer, about that, because everyone's in separate boxes here on this screen. But one thing that's kind of nice about this panel is because we have Andrew and you here, we can kind of talk a little bit about the cooperation. And I think behind the scenes, regulators of all kinds, whether it's NFA, CME, the Commission, even the Justice Department, when I was there, there's definitely a lot of communication that can go back and forth and coordination of efforts. I'm wondering what your perspective is on.
Yeah, it's been really great working with the CME on some of these cases. I know Andrew had mentioned the Peter George, and I'm going to butcher the name, but you did a very nice job pronouncing it. The broker of Roy Abbott Futures. So that was extremely helpful to get that information from the CME and be able to look through the transfer trades that they had seen and we had seen, and then going through all the different records. And we've had similar things with CME over the last couple of years in particular, where we've been able to contact them to get trade records and market information and other information that's been very vital to the cases that we've been working on. So it's really been great coordinating, not just with the CME, but then also with the CFTC and as you mentioned with DOJ from time to time. So when we have actions that we think are of a criminal nature, we'll contact the commission and DOJ and make sure that they're aware of some of these efforts. But it really has been, we don't try and do it so that there's too much overlap, but there is some overlap from time to time, especially in cases where the CME might revoke trading privileges and do things along those lines, and then NFA also wants to revoke membership as a whole, so that they can't trade on any of the exchanges.
One thing that has really changed a lot over the last year or two has been the rise of retail traders. And there's been sort of new micro products, for example, in our industry here that are gaining traction from the retail crowd. Well, has that impact? How has that impacted surveillance or monitoring for either of you?
Well, I can kick it off, and Jennifer, go for it.
Sure. So from our perspective, we're definitely taking a look at some of the firms that are targeting more of these smaller retail customers and making sure that they're understanding the risks that are involved in trading those products, and seeing if they're, what the commission rates are for the micro contracts as opposed to the minis or the standard size contracts. So we're really trying to focus on those firms that are targeting those types of customers, because they might not have the financial wherewithal or the experience to be able to understand the risks involved in those products. But we are seeing a spike in complaints from customers relating to those products, simply because these people are newer to the futures industry and don't understand how any of the products work, and so they're really it's something that's different, and they're trying to get a better handle on it themselves. But they're sometimes it's just a matter of contacting us to complain because they don't understand what it was that they were doing, and sometimes it's that the firms might have made errors as well. So we're taking a look at all of that.
Yeah, I think this is potentially one of the most significant things that if I look forward over the next call it 3 to 5 years, that firms need to be hyper focused on. And I'm talking the execution firms, the brokers, the FCMs, and let me put some kind of color around that. So one of our CME business colleagues was recently on a podcast. And he was talking about the fact that CME is now traded over 1 billion micro contracts. 1 billion micro contracts. The micro contracts on the equity products are almost over 1 billion themselves. 320,000 retail traders have traded our products. So it's large. And the reason why I'm saying it needs to be on everyone's kind of like radar 3 to 5 years from now. When I say that we have 320,000 retail traders, it seems big for us. I look back, 4 or 5 years ago, and we might only have had 300,000 traders in total on an annual basis. So we now have that many just retail traders. But if you look at like some of the crypto platforms, Coinbase has almost 70 million users. So imagine if some of those users migrate into an environment that is at least from my perspective, an arguably more safe, secure, regulated place. You can see a massive inflow of new retail traders, and from our perspective, it dramatically changes how we have to do surveillance. If we go back to earlier this year, I guess, when the Reddit Wall Street Bets crew started this movement to get into silver. And they started in the spot market buying cash silver. They were buying coins. They were doing everything, and then they got the idea of moving into silver futures. They called it the silver squeeze. And thankfully they talked about it for a long period of time before they all decided to come into the market, or they all had planned on coming into the market. They all said we're all coming in the market on next Monday. So it actually gave us a fair bit of time to get ready for it. And we were, we had our surveillance crew that was monitoring positions. Our investigations crew was monitoring, changes in profiles. We had already had, pre-written inquiries to send to the main FCMs that do retail business so that the second Monday hit and we saw any change in the market, we already had the inquiry letters written to go to the firms. We created new reports to identify new users, most profitable users that were new to the product. We'd always had reports to identify, trading in concert, and separate reports to identify what we call herd trading. Not really us, but it could be colloquially called this herd trading. So the way that we looked at this is way different than we had looked at anything before. It's not like looking at spoofing. I mean, you're looking for effectively concerted activity from multiple unrelated people that potentially have a disruptive impact on the markets. And firms need to appreciate that we're looking at it differently. We're going to send inquiries that are much different. And we may be taking a much more aggressive approach if we see disruptions in the market.
Yeah, now before I move on to anything else, I do want to note that the second of the two CLE codes is at the bottom. So please take careful note of that because you're going to need that to get CLE credit. It keeps scrolling and it's at the bottom now. So please take note of that if you haven't already. I will just say more generally, have there been some real changes in addition related to the use of third-party vendors and the supervisory responsibility relating to those? And has that changed at all over the last year or two?
So from our perspective, sorry, go ahead, Andrew.
I was going to say, Jennifer talked about it earlier, and I think that it's actually gotten me thinking on whether I need to do some cut and pasting from the NFA's new advisory. So it started everybody listening if Jennifer is now creating more obligations because I'm going to cut and paste her rules into ours. But the reason why I'm thinking about this is because we've brought actions before against participants who had issues with vendor provided systems. And more often than not, it's not necessarily that we're bringing actions. If a person's using a vendor solution and out of the blue that vendor solution malfunctions and it causes some disruption. And the participant did everything that they should have done. They tested it in advance. They had frequent interactions with the vendor. They identified issues proactively. We haven't traditionally sought to go after the particular person who's using that third-party system, and we don't have jurisdiction over the third-party provider, right? The issues where we have taken action is where the participant either neglected how he was using that third-party system, or failed in some other responsibility to simply supervise that third-party system. It's gotten me thinking. We've always brought those under either our failure to supervise rule or some of our more generic rules, but we don't have one that specifically talks about an obligation to supervise a third-party system. So I think it's a good development, Jennifer, for the market, I think.
Well, I think at this point we will open this to questions, and I think we already have some questions from the audience that I think are interesting. And one question in particular, and I'm going to direct this one to Jennifer, because you were talking about the changes, for example, regarding the definition of branch offices. One question that a member of the audience has is, well, what if you're working a lot from Starbucks? What if you are, using one of these sort of offices that you can, rent a cubicle in, right? Something like that. And what about some of these more unusual circumstances that we now have due to the pandemic, and how would that impact a firm that's operating in that manner under the new changes?
Yeah, that's a great question, and one that we've gotten a few times now from some of the different broker associations and things. But the important thing with the change in the definition of branch office is that a firm always needs to know where their brokers are working from. So whether it's working out of their house or their apartment, or whether they are going to one of these WeWork type places or rent-a-desk type of places, or whether they're going to be working at Starbucks, as long as the firm is well aware that that's where the person is working from, they can go ahead and do that and don't have to list it as a branch office. There was some question about whether several employees of a firm or several brokers of a firm could get together and rent a space, and because they didn't maybe want to work out of their apartment or their house, and whether that could whether they would have to list that as a branch. And that's where you really start crossing the line. So the idea was that removing people from the definition of branch office was to be for kind of these individual circumstances where they're working from a location that's other than an office of the firm, but they're doing it by themselves, or maybe there's a husband and wife that both work at a firm and they're working out of the same location. Those types of things are allowed. But once you start bringing in other brokers from the firm, then that starts to say, okay, now this is starting to look more like a branch office. In any event, the biggest thing is that firms are going to have to be able to supervise these people. So we're actually also going to be making some changes fairly soon to our interpretive notice on supervision and the supervision of branch offices and GIBs and brokers in general. And so it's going to talk a little bit more in there. But the idea is that really firms need to know how they're going to go about monitoring these people, even when they're working from a location other than a typical office of the firm.
Okay, some of these, we'll see whether you're able to answer these or not. One question from the audience is whether there's any concern that SunGard GMI is the back office for 70% of the industry. Is that something that either of you are able to comment on?
Well, I think from our perspective, with the new interp on third-party service providers, that's something that I think firms are going to have to focus on in terms of, so obviously they can do their due diligence, but making sure that if they're looking at the operations of some of these vendors, if something were to happen, do they have an alternative? And to think about coming up with alternative arrangements in the event that something were to happen. So I don't think NFA is going to take a position necessarily on whether it's a good thing or a bad thing that, one vendor in particular has such a large chunk of the industry, but it's something that firms should take a look at in their risk assessments.
Question now for you, Andrew. Should firm, how should how would I'm trying to word this in an appropriate way, reword a question in an appropriate way here. But I guess the question is regarding reporting misconduct to market regulation, and whether or not there should be an incentive for firms to be compensated as a whistleblower, and whether or not that should or would impact the information that's flowing into market reg from the community.
I may flip this question back. So here's my perspective. So a lot of people, and we get usually between 300 and 400 complaints a year from participants, and we keep track on how many of those complaints actually turn into formal investigations and ultimately lead into enforcement actions, and we get a lot of value from complaints from participants, and so there's no discounting the value in doing that. Often there is already a built-in economic incentive for people to complain, and that's because they perceive that there's some activity that's going on in the marketplace that's causing them some financial harm. So they're complaining about a competitor. That is overwhelmingly, the nature of the complaint. So there is that built-in economic incentive for people to complain. The one area that doesn't encompass are insiders within their own firms who don't necessarily have that same market incentive to complain against their own firm, and that's something that's not there today. Now, I don't know, and I'd be interested, Renato, on your take, if you think that firm employees, insiders, would have a greater incentive to self-report if CME had a whistleblower program, when there's already a whistleblower program in existence at the CFTC that has all the structure and administration from a federal agency.
Yeah, it's a good question. I mean, I think obviously at a very high level, the more you incentivize something, the more it happens, right? If we believe in microeconomics. So if CME had its own whistleblower program, then I imagine on the margins it would have some impact. I think it's fair to say you're right that CFTC already is sort of filling that void, and there's been some very large awards. I will say this: there are some market participants that perceive CME and CFTC differently. In other words, there are market participants who think that CME is unfair in the way that it administers its market or structures its market, and they have a different view of the commission as a government entity. There are people who think that the commission is unreasonable or unfair in its application interpretation of the CEA, and they have more confidence in CME as closer to and having a better understanding of the industry and of market participants. And so I could imagine some segment of folks feeling more comfortable talking to CME and having an incentive having some impact on that. But, I will say that I think the impact of these incentives are limited. As you point out, a lot of times people have their own reasons for coming forward. Some of them financial, but some of them not. Some people just have very strong views of how things are structured or what's going on, and they want to tell their story, so to speak. And I certainly, as a lawyer, have in private practice have come across many folks in different buckets, as it will, regarding that. I'm curious, Jennifer, do you have any thoughts on whistleblowers or whistleblowing in general, and on the public providing information, or more, I would say people in the industry providing information to regulators?
I think NFA has had the same type of experience that Andrew was mentioning, where it's competitors that are whistleblowing on other firms. We do get a lot of those calls, and those are usually pretty helpful. We have not really had much in the way of employees asking about whether there could be some type of compensation, but we do get calls from either current employees of the firm or past employees of firms that are willing to talk to us about different deficiencies and things that they've noted at the firms that they were employed at. So it's pretty helpful for us when we get those kinds of calls, and that they can provide us with the information on kind of where to go and look and see where the bodies are buried.
One other question that's come up, or a request for comment, is about floor brokers. And, there's obviously been a change. There's obviously been a changing of the guard, or changing of eras there. And I'm curious, Andrew, what your comments are, or at least what I'm seeing in the chat from the audience, the sort of request for comment on that subject.
Yeah, you mentioned at the top of the session, Renato, on the closure of the Chicago trading floors. And so we closed all the trading pits with the exception of Eurodollars and now SOFR. So all the legacy Chicago Board of Trade ag pits, the other financial pits and currency pits that had been open prior to the pandemic didn't reopen. And effectively, what happens is that you had all these floor brokers who had their floor broker registration status at the NFA. And that floor broker registration status allowed them to handle customer business from the premises of the registered entity, so CME. And because they no longer have permission to execute customer orders from the trading floor because those pits don't exist, they can no longer be registered as floor brokers. So tomorrow, actually, a significant number of former floor brokers are going to have their floor broker registration statuses terminated, which means that if they want to continue soliciting customer business, they have to find another registration capacity. We worked with the NFA, who was gracious enough to allow a grace period for these displaced brokers to gain some other registration status without having to take the Series 3 examination. So to the extent that a broker finds some other capacity to register, as an AP or whatever it might be, and they do that before the end of the year, they don't have to take the Series 3. But I think that's an important notice to go out to, particularly the FCMs or anybody else who may have to sponsor someone. There are potentially significant numbers of displaced floor brokers that will be seeking some other registration status in order to continue doing business. So if you see this inflow of requests for sponsorship or otherwise, this is the reason for it.
One last question. In the short amount of time we have left is directed towards Jennifer. There has been a recent swaps proficiency case against EDF Man. And would you be able to comment on that briefly? I know we have at least a couple minutes remaining here.
Yeah. So the case that was taken against ED&F Man concerned the new swaps proficiency requirements. So the compliance date of that was this past January. And so at that point, all of the APs of swap dealers and any registered APs of swap intermediaries had to have completed the training by that date. And so we went in to do an exam of ED&F Man and found that they had some of their APs that had been conducting business in swaps had not completed the swaps proficiency training. So we worked with the firm to make sure that those APs got the training in a timely manner, but there were a couple that the firm said, well, we're going to continue to have them conduct swaps business because they need to service these customers and they need to service these accounts. And so we recognize that them not having the training completed while they're continuing to do that may result in action. But we'll take whatever comes our way. And so that was really the focus of the case, was to say that, the firm was well aware that they had violated the requirement and continued to do so after we brought it to their attention, knowing that there could be disciplinary action as a result.
Wow, what a pro. Sorry.
Go ahead.
I was going to say you ended that right on time, because we now are going to have to end. We're moving to the next panel. I would just encourage, first of all, I want to thank you, Andrew and Jennifer, both for participating. Thank you both for your contributions. I know that I'm always interested to hear what both of you have to say. And I would really encourage everyone to stay and listen to the enforcement panel. I'm going to be doing so. Jake has put together quite a panel, and I'm interested in seeing the latest in enforcement developments from those folks.
Thank you, Renato, and thanks to you, Jennifer and Andrew. I thought it was a great panel. I took several pages of notes, so thank you very much. Audience, I hope you got the CLE codes. We're going to take a 5-minute break right now. We'll be back in 5 minutes for our enforcement panel. Look forward to seeing you then. Thank you very much. Well, welcome back, everyone. Hope you had a pleasant few minutes. We're now going to turn over to our enforcement panel. Before we do, a couple of housekeeping things. At 20 minutes and 40 minutes after the hour, LE codes will run across the bottom of the screen. Please make note of them. You'll need them later. We've heard from some people that the download all written materials link is not functioning properly. We'll make sure that you get the materials on an email subsequent to this program. So with that having been said, let's go over to our enforcement panel. We are honored today to have Rob Howell, Deputy Director of the CFTC's Division of Enforcement, Steve Schweitzer, Senior Director of Enforcement at the CME Group, and Jake Kahn, partner with Riley Safer, Holmes, and Consilla. Jake, will you get us started?
Happy to do so, Mark. Thanks for welcoming everybody back, and thanks everybody for sitting through the first panel here. We've got a great second hour for you. If you don't know them, you can see their names on the screen, but I'll just introduce them. Sitting to the right of me is Rob Howell, Deputy Director for the CFTC's Division of Enforcement, and to his right is Steve Schweitzer, Senior Enforcement Director at CME Group. Let me just give you an overview of what we're hoping to do in the next hour here. Really got about 3 different segments. Segment 1 is I want to ask Rob and Steve from their perspective to talk about what are the things they're seeing in the market. What are the trends they observe, and if to the extent they have any, if there are enforcement priorities at either CFTC or CME Group, to speak a bit about those. After we cover that, we're going to do a little bit deeper dive into 3 enforcement topics. First being spoofing. Renato touched a little bit on it in the opening panel. We'll dive a little deeper and ask some questions, both of Rob and Steve. After that, we're going to talk a bit about cryptocurrency, which has been in the news, both the broad media as well as CFTC, CME news. And then we're going to jump into an issue that doesn't get talked about as much, the issue of what is disgorgement. So those are 3 deeper dive subjects we're going to handle, and then finally we're going to do something that I will call the put the regulators on the hot seat, sort of a point-by-point question, and feel free to submit questions throughout if there's something we haven't covered, but want to make Rob and Steve sweat if we're able to by trying to answer some hard-hitting questions. So let's get started, though, at the outset. Rob, do you want to talk about from the CFTC's perspective, and I know you probably have a disclaimer to give, but from your perspective as Deputy Director of Enforcement at the CFTC, what things are you seeing? What trends are you seeing? And are there any priorities that you could speak about?
Sure. So, yeah, I got to give the disclaimer that my views are my own and don't represent those of anybody at the CFTC, the commissioners, Division of Enforcement staff, or anybody else. So I'm on my own here. Just starting with priorities, I think from enforcement, our priorities really don't change from year to year or even administration to administration. Sometimes there'll be like areas of emphasis, but really the market and the leads and our surveillance and all those kinds of things dictate the matters that we're looking into. And so, thinking about trends or what I've seen more of, I mean, I think you'll see as we're winding up to the year end in the next 2 days, that it'll be pretty much your standard sort of basket of cases that you see from year to year. I have noticed, I think there's more swaps reporting cases. I've seen a couple, Mizuho, Citibank, and a couple others that have come out. And I think part of that is that, swaps reporting, it's not a new thing anymore. And so if entities and market participants aren't doing what they need to do, then it could be an enforcement issue. The other is, and I think we're going to talk about later, is digital assets and crypto. There've been a fair number of cases. Kraken came out yesterday. And so that's an area where I think there's more than a year ago, so to speak.
And Steve, what about from your perspective at CME Group? Things you're seeing, trends in enforcement, and any priorities?
Sure. So in terms of trends, when you're looking at case types year over year, we're largely stable and consistent with recent years. You're going to see a similar number of enforcement actions involving wash trades, position limit violations. What we'd broadly categorize as non-competitive trading, you'll see those disciplinary actions that are publicly available time and time again. Even spoofing, we're still seeing a similar number to what we saw year over year. If you're a real student of the disciplinary actions that are published, you might, there's one exception to that trend, and that's in block trade reporting. That's not to say that we're not seeing the same number of violations. Many of those can be captured and resolved through the summary fine process under Rule 512 in the exchange rule books. And there was perhaps an anomalous series of actions that we saw go through the Business Conduct Committee last year. But in terms of case types, it's been roughly the same. Geographically, it's also more of the same. The majority of disciplinary actions are taken against U.S.-based entities and individuals. The next closest geographic region, or by country really, we're talking about, as you'll see, out of Asia and China. The one perhaps divergent area that we see some change in recent past, and maybe more so this year than in years prior, are the number of default cases. Those disciplinary actions that are taken in the absence of a participating subject or respondent in the enforcement process. That's down on both an absolute and relative basis this year than in years past. And what I mean by that in terms of raw numbers and the percentage of all disciplinary actions that were resolved up to this point are lower than the pace that we've seen in prior years. On the question of our priorities, our priorities to protect market participants from abusive conduct. That's kind of a eye-rolling inducing response to that question, but it's true. That's our constant, and that's what you'll see continue on through the rest of this year and the years going forward. As far as enforcement focusing on a particular case type, there's none that are predetermined. That's dictated by the market, so to speak. In other words, on the enforcement side of things, and even on the investigation and surveillance types of things, we're going to take what the market gives us, what we observe as far as rule violations. As a department on the whole, we're continuing to enhance our systems and monitoring of rule violations. And naturally, as rules are amended and changed, then the enforcement actions are sure to follow for those amendments and rule violations. I think that was touched on in the earlier session. And what we'll also see going forward is where there are different ways of violating the existing rules. We may see different means or methods of engaging in similar type of activity, but with somewhat different fact patterns behind those disciplinary actions.
So I think we may come back to that last point in a few minutes. And then I do want to follow up later on the default issue. I do have some questions about that. Let's switch now to the topic of spoofing. There've been, Renato talked about several high-profile criminal cases, wins and losses in the past 2 years. There have not been, however, as many CFTC prosecutions, and even disciplinary notices at CME Group have declined. So I want to ask some questions about that. Is CFTC, Rob, in 2020, I counted, I think there were 9 spoofing actions that the commission brought. 2021, there's one spoofing action, and it actually relates to a complaint filed in 2018. So the question, Rob, is, from your perspective, is the CFTC think it's done with these cases?
No, for sure not. And I think one thing, I checked the numbers, and I think a year ago, almost exactly, towards the end of the last fiscal year, there were 5 cases, and one of them was JP Morgan, which was a $900 million CMP. It was the biggest spoofing penalty. But no, the numbers are the numbers. And I think the decline in numbers for this year is just sort of based on what cases and what we've seen, rather than certainly any decision by the division or anybody not to bring spoofing cases. I think the reality is that spoofing cases have gotten more complicated and take a while to put together. And as a lot of these have gone to trial, we need to make sure that the cases, are strong and we would be successful in litigation. So I think there's a few things going on though, specifically in spoofing. In that I think a lot of the firms' compliance programs have gotten a lot better. And I think the spoofers that are out there and continue to do it are much more sophisticated. It's much more complex. We'll see countermeasures to try and disguise the behavior and make it harder to prove up. There's things cross-market and correlated market spoofing. There's, spoofing across traders, like across a tag 50, and also potentially cross-jurisdictional, and then potential spoofing that could come up in things like swaps and digital assets. So we're still looking, we still have active matters. But the numbers are the number. I would expect there will probably be more spoofing cases next year if there's only one this year. But that's where we are in spoofing. We lump it in with disruptive trading, and so we don't, we have sort of a broad category. But as far as spoofing specific cases, it's certainly a priority. We've ramped up. We have T+1 data for the last 7 years. We have the programming, the algo programming, and traders that are doing surveillance on it. So it's certainly a priority and something that we continue to be focused on.
So let me just follow up briefly. The prior director of enforcement, the CFTC, Jamie McDonald, talked a lot about smartly allocating a limited set of resources. Tips come in. At some point in time, the Division of Enforcement has to decide, hey, we're going to commit our resources to this, or we're going to commit it to this. From your perspective, can you talk about it all? Hey, is there less emphasis? We need to get out there and prosecute spoofing now?
I don't think there's less or more, to be honest. I think it's the same. I think there was a period where technologically there was a ramp up for us, and our ability to evaluate these cases and process the data. There was certainly a lag there, but I think we're pretty good now. And certainly the access to the market data is important. But I think it's been like that for a couple of years now. And so I don't, I think I would say it's the same moving forward.
So Steve, let me ask you then.
Sorry.
It
certainly has not been deprioritized.
Got it. Understood. So Steve, at CME Group, I did some counting as well with your help, I'll acknowledge. But there's similar trend. Going back 2018, there were 48 spoofing disciplinary actions. 2019, 34. 2020, 15. This year, we're at 11. I mean, it's a clear trend downward. So I'll ask, what's your perspective on this? Are folks in the industry doing less spoofing? Has the nature of the spoofing changed? Are we dealing with cross-market spoofing, as Rob indicated? It's tougher to track down, tougher to prove up. What's your perspective?
So, well, you're right. I mean, the trend does tell a story. That's not to say that it can't ramp up at any given time, and that next year or even the end of this year will be somewhat different, but there is a clear pattern that you've identified, and it is happening less frequently. And not only less frequently, I would say that the instances that we routinely view in the market are of a smaller scale. And that I attribute to a few reasons. One is education, and through our rules and regulatory outreach program. And as Rob mentioned, is that the firms that might ultimately be responsible for the activity of the traders are better at looking for it themselves and enhancing their own compliance programs, because they don't want to be on the hook for it, either through a supervisory position or as outright position as being the entity that's ultimately responsible for it, as I said. Early intervention is another aspect that I think has gone a long way to influence both the number and the size of the instances that we see. And what I mean by that is our investigations group in market regulation will oftentimes reach out to the participant where we're seeing these patterns that give an indication even that it might involve spoofing and stem it off before the case swells to something, or the instances swell to a number where it's untenable or becomes something that is problematic on a larger scale than it already is. And I'd like to think, and I will be a proponent of it, that deterrence works to the extent that disciplinary actions are noticed by the public, or they're taken against the individuals or firms themselves, who then modify their behavior as a result of the disciplinary actions. And that I consider to be a successful disciplinary program, and something that we want to achieve ultimately through our disciplinary program. Is spoofing happening differently? Yes, for sure it is. And we've accounted for that, and we continue to account for it. I think that it's, on the whole, rarer to find what we might call plain vanilla spoofing, at least over and over again. You do see these instances of cross-market, cross-exchange spoofing, whether it's related markets or at the same exchange or across other exchanges, as Rob was mentioning. And that does require more heavy lifting. And in fact, it may be that you have to look at those other exchanges as part of your investigation. For example, where we're questioning a subject of investigation as to why they're entering and then canceling these large orders, or a series of large orders throughout the order book. Sometimes the response that they provide is that they were influenced by activity on other markets, other exchanges. And then we'll have to look into those. Our information sharing agreements across exchanges and regulators goes a long way to assisting each other. Again, as Jennifer and Andrew mentioned on the first panel, is the relationship with other regulators goes a long way in advancing the ball on not only our disciplinary actions, but at the investigation stage as well. So yeah, it does require more work. We've dedicated resources and attention to those issues, and we'll continue to bring spoofing cases as they come into the market in our exchanges.
Let me follow up and ask you about two topics. One was, you mentioned education, and you mentioned reach out. You mentioned affirmative reach out by CME to market participants. My understanding is CME wants to encourage participants to reach out to CME, to ask questions of CME. And in terms of education, there's been the very extensive the MRAN notice for Rule 575, with a laundry list of frequently asked questions, illustrations of things that may constitute spoofing. So question to you is, has that been effective? I mean, that's probably one of the more comprehensive sort of guides for people in the industry. What should you do? What shouldn't you do? What should you be wary of? What's been your experience having released that?
So the experience is, yes, it has been effective, even if it was only to the extent of highlighting the issue and eliciting questions from market participants. I mean, the obvious upside to the MRAN is that it's practical guidance that it provides. It's in the supplemental form. It's real world examples of what we've been asked in terms of what's allowable under the rule and how the rule might apply to certain activity. I mean, it's, I guess, hidden in now a commonly seen acronym of FAQ. These are frequently asked questions. So we wanted to provide answers to those questions because we expect that many others have them or will have them in the future. So there's a purpose behind that. So that's our outward facing response and educational effort, in addition to what's been done publicly and visits and meetings with market participants. On the flip side, and maybe a not so obvious benefit.
Before you get to the flip side, Steve,
Sure.
Before you
Sure.
get to the flip side, I just want to interrupt you and remind people to copy down the CLE code at the bottom of the screen if you're tracking that. It'll keep running for another minute or so. Steve, sorry. Go ahead.
Not at all. Not at all. It's important. So I suppose I'm saying the somewhat hidden benefit, if there's one on the MRANs, is that at the end of each MRAN, and if you get to the end of it on 575, is no exception, is that rather than merely listing a general number for the department or for the exchange or a general email address, each MRAN, not just 575, but each one provides a contact point for the subject matter experts on what's covered by the rule. And the obvious purpose behind that is because we realize that timing can be an issue. These are things that are happening in flight that participants will have a question about whether or not it's something that they could go forward with, that they're seeing in the market, that they're concerned with, and they need to get to the subject matter experts immediately. So we provide several points of contacts on each MRAN for participants to reach out to directly, ask their questions, and we work hard to make sure that those responses are had as quickly as possible.
Can participants reach out on an anonymous basis?
Yes. So, right. I mean, it's more difficult if you're using contact via email. If you have an anonymized email address, that's something that might help. But we do provide for anonymous complaints as well. And you could find that information in the market regulation page on our public website, cmbgroup.com. Suggest scrolling down to the bottom, and you'll find regulatory guidance links and contact information for market regulation. So both in terms of asking questions and submitting complaints, that can be done anonymously.
So let me, at this point, try to utilize a function here, because I'm curious what the audience's view is as to this MRAN, which has gotten a lot of attention, justified attention, and as I understand it, from CME's perspective, has been worthwhile. I want to try to put up a poll and see if folks can click on their responses, and we'll get some live feedback here. The first poll is the question: how do you feel about CME's market regulation advisory notice for Rules 575? And this is including the FAQs. Is it helpful for market participants? Not necessary. Everybody knows what a violation is when they see it. Too much detail. Improperly assumes bad intent based on what may be justified trading strategy or something else. So go ahead and select an answer. Let's see if we can get some live feedback here. There you go. Not too much detail. Well done, Steve and your team.
Thanks.
Let's jump away from spoofing for a few minutes here. Want to talk about cryptocurrency. Rob, you mentioned these cases have picked up steam a little bit, maybe a bad word, but there's been high-profile cases, high-profile articles in the news. If you read New York Times, Wall Street Journal, you've seen them. I was just pulling some headlines. July 23rd, New York Times, crypto nomads surfing the world for risk and profit. July 25th, leaders in the cryptocurrency industry move to curb the highest risk trades. Wall Street Journal, August 23rd, cryptocurrency surge leaves global watchdogs trying to catch up. So that's what the public at large is reading. And in the midst of this, CFTC has brought some pretty significant enforcement matters. Rob, I'm hoping you can tell folks a bit about the BitMEX case. I know it's an ongoing matter as relates to a few defendants, but there was a notable settlement earlier this year in the BitMEX litigation.
Sure. And let me just back up, because sometimes there's some confusion about our role. From an enforcement perspective at the CFTC, when we approach a digital asset matter, we're typically looking, is it a security? Is it a derivative product? Or is it a commodity? As most folks here know, we have regulatory authority over derivatives. So in that case, it's fairly straightforward. If it doesn't implicate a derivative product, Then if it's a cash commodity, then we have enforcement authority, which is more limited. We have anti-fraud and anti-manipulation authority. And typically we're bringing cases there that have a nexus to the derivatives market. So BitMEX falls into the earlier category. I mean, the allegations in that complaint was that BitMEX was offering futures and options and swaps. They were, the allegations were they were located in the U.S. and they were offering it to U.S. persons. And so, that's clearly a problem for us. And I think that, in that sense, things are pretty straightforward on the application of the, of the CEA and the regs to the crypto world. And the reason I address it is there's a lot of talk about sort of lack of clarity and gray areas and things. And I think this is one where it's fairly clean. We settled recently just with the entities, the BitMEX entities, for $100 million. It was we did it in conjunction with FinCEN as well. And I think really the message in that case is that if you're going to offer derivatives to U.S. persons and operate in the U.S., you have to be registered. And it goes to, our principles-based regulation, which is fairness. You can't have regulated entities competing with unregulated entities. And so I think BitMEX was an important case for us in that respect.
Steve, let me jump to you for a minute here. CME has offered crypto derivatives trading for, I think, about 3 years now. The concern at the outset when CME said we're going to start offering futures on Bitcoin was volatility is going to be insane. This is too risky. What have you seen over the past 3 years? And have there been disciplinary actions taken as related to crypto derivatives?
Yeah, so, briefly, just from a business standpoint, it's been a success. We're seeing trading in our futures markets on these products. So it's, I think out and out, it's been observable to be a success. From a regulation standpoint, though, it has not raised any particular concerns. It's viewed in the same light as the other future contracts that we're continuing to monitor. So we have surveillance we have investigations that looks into all activity across the board, irrespective of the market, as long as it's one of the markets traded on our exchange. That's really the only requirement. So it doesn't mean it's being ignored because we haven't had any disciplinary actions, and I'm happy never to have any disciplinary actions involving it. So that's not an end goal. It will continue to be monitored. We're set up for it. We'll continue to look into it. But there's nothing that's particularly troubling from a regulatory standpoint.
So Rob, I'm swinging back to you now because you brought it up, the general notion of sort of a lack of clarity. Could you talk a little bit about, I know your office prosecuted the Coinbase case that resulted in a settlement.
Yeah. So I would say, as I was sort of talking about, for us, there's essentially the two buckets. It's whether or not it involves derivatives, which is fairly straightforward. If it doesn't, which is the Coinbase case, they didn't offer a derivative product, then it's a function of our more limited anti-manipulation and fraud authority. And in Coinbase, the allegations, that was an administrative file and settle. The allegations there was wash trading, and there was also false reporting, which I think fed into the BitMEX index at the CME and New York Stock Exchange. So that's an example of where cash transactions, if it implicates or pricing integrity, that's an issue. And so I think Coinbase, I would say, is sort of the second, fits into the second bucket as far as the digital assets go.
And Coinbase, the announcement got a lot of press because Commissioner Stump submitted a concurring statement with that announcement. And so this was March of this past year. And I just want to refer to a couple points there. The statement suggested really the CFTC should not dedicate resources to matters not directly involving derivatives on cryptocurrencies. And I think as you know, maybe there's a lack of clarity, but certainly there's a debate. And I think this statement highlighted who should be regulating these products. I want to call out just a few points from Commissioner Stump's statement. One, she says, quote, "The CFTC does not regulate cash digital asset exchanges," which of course was what Coinbase was. The second was, Commissioner Stump said, the CEA provides, quote, "limited enforcement authorities with respect to cash transactions." And I think that's what you're talking about, more limited fraud and anti-manipulation authority. But despite the views of Commissioner Stump, the CFTC has continued to press forward in these cases. And there's examples from the past year. March of 2021, the CFTC filed a complaint against John David McAfee in the Southern District of New York. It was highlighted on the CFTC's website, the first manipulative scheme charged by the CFTC involving digital assets. That was a Rule 180.1 case. No derivatives at issue in the case. That complaint's pending still. There was a settled administrative file and settle action, April of 2021, in the matter of J Squared Investment LLC, Joseph Gurman. This is another manipulative scheme, solicitation of investments in digital assets. Again, though, there's no derivatives at issue. This is cash digital assets. And then just yesterday, in the Kraken case, this was charges against Kraken for offering illegal off-exchange digital asset trades and failing to register within the industry. As I read it, the case is a little different in that Kraken was offering margined retail transactions, slightly different than sort of pure one-on-one cash transactions. But again, Commissioner Stump filed a concurring statement with that and really was focusing on her view as to the lack of clarity here. And what's interesting is the CFTC's the settlement order says Kraken failed to register as an FCM, but as Commissioner Stump pointed out, well, they're really acting as an exchange, not as an FCM. And if they had registered as an FCM, they can't also register as an exchange. So how could they operate in this market? Her view is there's still an ongoing lack of clarity here. And the question I think folks have in their mind is, where does the CFTC's jurisdiction end? You talked about, you evaluate the case. Is it a security? Is it a commodity? Who has jurisdiction? Who should exercise jurisdiction? And I want to point out that this is an issue that has not clearly been addressed by any appellate court. The Ninth Circuit in the Monex case a couple of years ago suggested that, as you said, the CFTC may well have some limited jurisdiction over transactions in the cash market that extend beyond commodity futures transactions and leveraged commodity sales. But the Ninth Circuit didn't address the question because it didn't need to in the Monex case. And the CFTC continues to take the position that you articulated. There is this limited anti-fraud, anti-manipulation authority for a pure retail cash transaction. If you look at the CFTC's enforcement manual, it says on page 2, quote, "The CFTC has authority to prosecute fraud and manipulation in connection with commodities in interstate commerce." And what is interstate commerce? Well, my reading of it is, if there's fraud, a fraud scheme involving the sale of a truckload of eggs going from Milwaukee to Chicago, the CFTC could bring an enforcement action. And so, Rob, the question to you is, why does the CFTC care about a truckload of eggs?
And I'm not sure we do. I think there's a distinction between like our regulatory function and then the enforcement function. We have in the limited enforcement over fraud and manipulation, which we sort of discussed. But I think in practice, if you look at the cases that we bring, there's a link between the underlying cash market, the transactions, and the derivatives market, which we're charged with protecting. There's some nexus or some impact. So in the Coinbase, I said, we felt the conduct, it was reporting an issue with the conduct going to the Bitcoin index, which there's a concern about affecting pricing. And so I think if you look at the CFTC matters where it is a spot transaction or cash commodity transaction, I think you will typically see articulated the nexus between the derivatives markets and the underlying spot transactions.
Where's the line? You talk about there's got to be some nexus. Is there any line that market participants can look to say, hey, if I'm somehow embroiled in this, I need to be wary because this crosses that line. This could fall within where the CFTC believes there's enough of a connection to bring an enforcement action. Where's that line?
I don't know that there's a bright line, although I did suggest to your client that maybe don't manipulate or commit fraud would be a good starting point. But no, I don't think that there's a bright line of a percentage or something of the impact. I think we look at these cases, we have, as Commissioner Stump's statement suggests, we have limited resources. And so I think when we evaluate and look at cases, if we're going to bring a case in a cash commodity, we look for something that's going to have a significant impact, on our markets.
So as I noted, this jurisdictional question has never been really addressed by an appellate court. And to your point, I would note Commissioner Stump's statement never says the CFTC doesn't have jurisdiction. It just says, arguably, it should decide when it goes after the truckload of eggs. So what's needed to clarify this a bit? I think we're probably going to need some appellate court to address the issue. And there is a pending CFTC appeal of a CFTC final judgment after a hearing on the merits. It's up in the Ninth Circuit right now, the Saffron case, SAFFRON, appeal number 21-15952. That involved underlying scheme with fraudulent solicitation of Bitcoin, but no derivatives at issue. So that maybe that's a case where this issue might finally get addressed clearly by an appellate court. Let's step away from cryptocurrencies. I want to talk about something that isn't talked about as much, which is the issue of disgorgement. Question is, what is disgorgement? Well, the Commodity Exchange Act says on its face, the CFTC is authorized to seek, quote, disgorgement of gains received through a violation. And the CFTC routinely does that in trade-based cases, manipulation, spoofing, where there's an impact on the market. There's a calculation of disgorgement, and the defendant is ordered or agrees to pay that as part of a fine. And CME Group, Steve's team does the same thing. There's disgorgement ordered in CME disciplinary actions. And there's not a statutory authorization to do it, but they are acting pursuant to the Commodity Exchange Act, which regulates them as a designated contract market. And the BCC has authority under CME Rule 402(b)(11) to order a party to disgorge any monetary benefit resulting from a violation. And there's examples, early September this year in the matter of Robert Anthony Ross. This was a spoofing case brought by CME and $10,000 in disgorgement. So it seems pretty straightforward. You disgorge the profits. But I submit that it's not actually straightforward, because how are you calculating what those profits are? Let me give you an example. You have a spoofer, somebody who's long 10 futures contracts, enters a large buy order, and then quickly cancels it to move the price up and offload his position on his long position. What's the appropriate disgorgement amount for that trader? Before we answer that, copy down the fourth code that is floating across your screen right now if you want to receive CLE credit. All right, so we have, though, pretty simple one transaction, the single spoof or single market. This is not the complicated scheme that Steve is up at night fretting about. This is cut and dry, should be easy, right? You figure out what's the revenue that the trader received when he sold the position, and you subtract out what he paid to put on the position. Well, what about the trader's legitimate business expenses? What if the trader leased an office in which he did the trading? Do you consider that at all in calculating a profit or unjust gains? Well, until last year, almost all the appellate courts had pretty clearly held that no, when you calculate disgorgement, you don't need to take into account expenses, legitimate expenses that aren't related to the specific transaction at issue. But the Supreme Court weighed in 2020 in the Liu case, LIU versus SEC. And here's what the court said. The court said, courts may not enter disgorgement awards that exceed the gains, quote, made upon any business or investment when both the receipts and payments are taken into account. That's not the clearest statement. But then they said, courts must deduct legitimate expenses before ordering disgorgement. Must deduct legitimate expenses before ordering disgorgement. That was in an SEC case. And so the question is, does this Supreme Court decision apply in this industry? You know, cases are not brought under the Securities Exchange Act, as was Liu. They're brought under the Commodity Exchange Act. And I would ask Rob his position, but he's told you already his views don't represent the views of the commission. So I'll tell you what the views of the commission are, because they've told us. They've submitted a public filing in the Middle District of Florida in the Montano case, CFTC versus Montano. This is in the materials. And the CFTC in Montano was presented with the issue of, wait, don't we need to look at legitimate business expenses? And the CFTC says, well, no. Liu was an SEC case under the Securities Exchange Act. The principles from that case don't apply in cases brought under the Commodity Exchange Act. But if you read the decision in Liu, the court, when they're talking about what are the bounds of disgorgement, what does disgorgement mean? They're not looking at whether or not the statute says you can seek disgorgement. They have already concluded the SEC could seek disgorgement, and they were trying to figure out, what does disgorgement mean? So what difference does it make if the Commodity Exchange Act authorizes disgorgement and the Securities Exchange Act doesn't? I submit that there is no difference. There's no reason why the rule announced in Liu should not apply in the futures and derivatives industry. And how does that touch CME Group? Well, they're acting pursuant to authorization from the Commodity Exchange Act. How could they have broader discretion than could the CFTC? All of which gets then to the question of what is a legitimate business expense under Liu? What can you deduct, and what can you then ask the CFTC, push back and say, we don't like your disgorgement calculation. It doesn't account for this, this, or this. In Liu, the Supreme Court suggested maybe an office lease. An office lease might qualify as a legitimate business expense. There have been some prior cases where courts had said, well, if you've paid commissions, and you have to pay commissions as part of your fraud scheme, for example, you might be able to deduct those. There's unfortunately not been a lot of clarity in the last year since the Liu decision came out as to what else might qualify. So we're going to do the next best thing, which is we're going to ask the audience what qualifies as a legitimate business expense. So we're going to do this poll again and ask you to participate and answer the questions, which of these are legitimate business expenses that could be deducted when calculating disgorgement? Computers and monitors, health insurance for traders, fees paid to an accountant for tax preparation services, a refrigerator full of Red Bull. Are any of these legitimate business expenses? Clearly the Red Bull is, but only Red Bull. Other energy drinks don't qualify. we're gonna keep down these percentages here. I'll submit them to Steve and Rob after the webinar, so that in the next case you can reference this as to what does the reasonable person believe is a legitimate business expense. All right, we've got time still. Let's move then to the last section here, which I've called putting the regulators on the hot seat. And Steve, I want to start with you. Because you brought it up earlier, you talked about, maybe a market decrease in the number of default actions that CME brings. But anybody who follows CME disciplinary notices, there's always one, maybe two, and sometimes it's more than that, where there's a notice brought against resolving charges against an individual or an entity that did not contest the charges, never answered the CME group's complaint. And many of those notices include fines that presumably are never paid. There's three, for example, on July 9th of this past year, three of these default, nobody answered, nobody showed up. So question, Steve, is why is CME spending what you said are valuable resources pursuing people who just appear to disappear?
All right, so again, to go back to the obvious, the main reason is that it is our mandate as a DCM, as a designated contract market, that we have to have a robust disciplinary process, and where there are what we would categorize as obvious and provable rule violations, we will proceed on all of those, if they're at least to the extent that justifies the use of resources. But then the question obviously has it's built in a issue of, well, do you have some prosecutorial discretion, and where do you want to apply that discretion? Well, on the one hand, we do believe that even though these we'll generally refer to as default actions are brought against those that we don't expect to hear from after the fact, once the case is resolved before our disciplinary committees, we do believe that there still is a deterrent effect, not only individually on those participants, but on others who may see it. We do want to encourage participation in the disciplinary process, and if you were to do, to the best of your ability, a one-to-one comparison of a case type where someone had settled their matter before the business conduct committee and those that were taken through the default process, you'll notice that the penalties that are issued for the default respondents are much more severe on a comparative basis. Another reason why we'll go forward with this is because we cannot say with any certainty what's going to occur at the beginning of the process. We've had probably every iteration, given the multi-step phases of a case making its way through the investigatory and the disciplinary process of respondents participating and then not participating. Sometimes they answer every question, participate in every interview, and then once the matter is ready to be resolved with the enforcement group in market regulation, they may drop off, they may stop responding, or they might not have responded at all until the case comes to enforcement, and then they realize, maybe in some cases, that, oh yeah, this is actually real and there are consequences to it, so they may then participate. We've had respondents who haven't come up until they've received notice of a disciplinary process that was taken by default, and then they want to have a further discussion. And sometimes, and oftentimes in that case, depending on what point it is, it's too late. So there is an issue that they have with not having an ability to resolve it any further. But we've had that case too, is where we've had a motion for default granted, and then the participant says, well, wait, maybe I do want to talk about this with you and see if we could resolve it amicably, and then bring it before the business conduct committee. And something else to keep in mind is that the only other option, and again, depending on the size and scale of the activity that we're seeking to address the disciplinary process, is if our option is to do nothing, it's not tenable. We will address this apparent rule violations, again, that we have evidence of, that we believe that we could prove and meet our burden. If it was to go to a contested hearing, we're going to bring those cases. Yes, it involves some work, but we're willing to do it in order, again, to loop back to my beginning comments, is to protect market participants from abuses, and especially in those cases where there's customer harm and there may be customer restitution involved. I suppose it's worth mentioning here as kind of a reminder to firms, in particular clearing member firms, is they may be liable for customer restitution in those cases where other customers have somehow caused some harm. I know that's a loaded response that might generate a lot of questions and other issues of consideration, but we'll put that out there and leave it for the next panel.
And you talked about deterrence of future participants committing similar misconduct. What is CME doing to make sure the same respondents who took part in this misconduct aren't coming back?
Yeah, so I think what is often a question of a related nature is what's preventing someone from using another name, new identifiers, attempt to open an account and then again resume trading on the exchanges, or open an account through someone else, a sibling, a spouse, something of that regard. And there are a couple of things that we rely on in order to prevent that from happening. The first is that we're going to continue to monitor the activity, and if it's a case of a potential recidivist engaging in the same activity, same violative conduct, then we're continuing to monitor that, and we will observe it and then take action, even if it is under another name. But the partnerships that we have and reliance we have on our clearing member firms is much more than just surface level, is that we rely on them heavily to have robust onboarding processes in place so that they are performing due diligence on who they're opening accounts for, whose accounts they're clearing, and to ensure to the best of their ability that this isn't someone that has previously been suspended or has an access denial against them from trading on the exchanges they indicate that they will trade on once their account is open. I mean, not only do we assume that it's more than, I guess, assuming tacit knowledge of the disciplinary actions that are taken. We proactively provide those disciplinary notices to the clearing member firms so that we can be assured that they do have them, that they see them. But again, based on experience, anecdotally, I could say that the compliance offices at all the clearing member firms do pay attention to those postings. They come back to us and ask questions, and it's not uncommon for compliance departments to reach out to us and say, this name looks a lot like a customer that we have on our books, and we want to do what we can to ensure that it either is the same and that we can take action, or that it is not the same individual that you have named in your disciplinary posting, so that we don't feel compelled as a clearing firm to do something more.
All right, I'm putting the spotlight on Rob now. Rob, I'm talking to you about coordination with criminal authorities, CFTC's coordination, and maybe what I'll refer to as the piling on issue. So I counted again because I like to count. 16 parallel actions, criminal case, CFTC case in 2020, and about 10 or so in 2021. Ongoing trend here. Is there ever going to be a situation where there are criminal charges filed in a case involving derivatives trading where the CFTC doesn't also bring an action?
I'm sure there will be. I mean, for simple reasons like, our statute of limitations is shorter than the criminal people can go back. And look, everybody, kind of like Steve said, I mean, we have a mandate to enforce the CEA and the regs. And so we don't know when we start an investigation necessarily what law enforcement agencies or exchanges or whomever are going to do. They have to make do their investigations, make an independent decision on whether they're going to bring a case or not. And so we have to do that as well. And at the end of the day, maybe DOJ decides they're not, it's not a criminal violation or whatever. we still have a responsibility. The other thing is we do different things than the Department of Justice, and serve different functions. We can freeze assets to try and get money back to victims. We can do that fairly quickly. We can ban people from the industry, trading bans, registration bans. And kind of like Steve suggested, it's important to get the word out if they're bad actors. I think just the publicity of an enforcement action is important, and it sends a message to the market. It also helps us if you've got repeat actors. I mean, we've got cases in-house now where people are violating prior orders, and it makes it so we can go after them. So, yeah, I mean, and I think having a lot of cases that resolve together, a lot of times that's driven by defense counsel. They're being looked at by various agencies, and they say, I want a global resolution. And so, yeah, I mean, the numbers don't surprise me. We work really well with all different law enforcement, foreign regulators, the exchanges, but everybody's got their own responsibilities and their own job to do. And at the end of the day, their own assessment of whether or not this violates their rule book or their statute or the criminal code.
And you mentioned in the early part of your answer, maybe DOJ decides not to take action. Well, in that case, CFTC could evaluate on its own and decide to, press forward. Would there ever be situations where, because you say this is maybe the fault of defense counsel? Is those the words that came out of your mouth?
No.
Anyway. So as defense counsel, you're sort of dealing with inquiries coming from criminal authorities, inquiries coming from the CFTC, and it's sort of like, can't we just deal with one at a time? Would there ever be situations where the CFTC might enter into like a tolling agreement, for example? Hey, I understand the DOJ is investigating this, we'll agree to step off to the sidelines. And if DOJ, pursues an action, gets a conviction, maybe there's no need for the CFTC to take action. Is that something that's ever in the realm of possibility?
I'm not sure. I mean, I don't know in that like formal way. I mean, certainly we have situations where another regulator or an exchange brings a case and we may evaluate it and say, you know what, it's been handled, so to speak. Whether or not we would execute a tolling agreement to do that, I think is kind of unlikely. But I guess you could never say never. I mean, again, we're not going to hand over our responsibility and decision-making and evaluation to another company or agency. So at the end of the day, like, we need to make an assessment of whether or not we think it's a violation or an action we should bring. Certainly we can take into consideration penalties and other matters, or different sanctions that occur in other matters. And so it's more likely that we would try and work it out in the, penalty assessment or sanction assessment.
And then Steve, if DOJ is taking action, the CFTC is taking action, there's no deterrence need for CME also to take action, right?
Well, I guess it's the famous "it depends" answer. What's the outcome of those, and if all of our interests at the exchanges and by the participants been addressed? If that's the case, there may not be a regulatory purpose behind taking further action. Timing is important, though, and that assessment is: have we already resolved our action? Then that ship has already sailed. The question, though, is legitimate, and one we would consider is: what else is there to be gained? If all of our issues vis-a-vis the exchanges and other participants have been addressed, we will take those prior actions or other actions into consideration.
And Jake, can I add one thing? Just like in a lot of these matters, I think if you look closely, there are like different parties named, or the conduct's slightly different. And so it's easy to say, okay, the two penalties, this has got to be piling on. But like, I mean, I saw it in a lot of the spoofing stuff a few years ago, where the CFC action would be against like an entity and a trader, whereas the DOJ was particularly focused on the individuals. And so sometimes you have to look at the actual package of what's being done and who the entity is and what the conduct is, because we all have slightly different takes and slightly different mandates.
Sure. And again, as I heard you, default to defense counsel. So real quick, Rob, on in last December, the VTOL case, CFTC moved forward, big announcement, the first CFTC action involving foreign corruption. That came 2 years after the big press, hey, this is going to be a focus of the commission. It's been the only case that's come out, nothing since last December. Was this much ado about nothing? Are there open investigations involving foreign corruption? Is this still a priority?
So it's still something that is ongoing and a priority. I don't want to comment on whether there's open or closed or anything in between. I will tell you though, like the nature of a bribery, foreign corruption, foreign manipulation type case are, again, kind of like the spoofing, tend to be very technically challenging and difficult. And you're also talking necessarily about other countries. And I think that is one area where COVID has slowed things down a little bit. But I would expect to see more cases in that vein moving forward. Whether or not there's a big glut, I doubt there would ever be a big glut, but I certainly think that those are areas that we're looking at. And really at their core, their manipulation, their disruptive trading cases, which we do all the time. They just have the wrinkle that, there's maybe a bribery angle or a foreign corruption angle to it.
Okay, Steve, we're going to you, and you may be the last question on the hot seat here. Your colleague, Andrew Vrabel, in the prior panel was asked about, is there going to be a whistleblower program at CME? I'm interested in asking you both about whistleblower and cooperation. As I'm sure you know, the CFTC has made a big push. Hey, we're going to give credit where people cooperate. You mentioned if people show up and participate, that alone might result in a reduced fine in a disciplinary matter. But is there extra cooperation credit that CME gives? And if so, why not publicize it?
Okay, so a lot there. I'll try and hit them quickly because I know we're towards the end here. Yes, we do give credit for cooperation, but the key word is it extra cooperation. It's often the case that our business conduct committee will ask us during the course of a settlement hearing where there's mention to the panel that the respondent in our case has cooperated fully with market regulation during the investigation, during resolving the case. And they'll say, well, what was special about it? Because isn't cooperation required? And they're right, is that under our rules, cooperation is a mandate for participants on the exchange under Rule 432L. So it has to be something special, something extra, as you asked it. And we've had those postings that have made mention of the cooperation, that the panel has considered that significant cooperation in assessing the penalty. And it's something that we're to advocate for in front of our BCCs if it is an example of something above and beyond. Does it involve true self-reporting of a violation? And in fact, in some situations, the self-report alone may influence us not bringing a regulatory action if the activity has been redressed in some way, depending on what it is. If it's still a rule violation, our mandate stands, and we will take disciplinary action, but that's something that could heavily weigh into what our recommended penalty is to the business conduct committees. I would say, straight participation, that would call for a sanction that you would see commensurate with other cases that have gone before it. I would just add that in the default cases, what you'll see is a premium, if you will, added to the penalty. So it's above and beyond what would be, if you want to call, a typical penalty for that type of information. On the whistleblower issue, Andrew answered that perfectly. I don't have anything additional to add on that.
Well, all right. Let's throw it then to the audience. Let's throw it to the audience. Final poll for this panel. Would you be more willing to report potential misconduct to CME's Market Regulation Department if you knew you might be compensated as a whistleblower? Yes, no, or only if they offer free whistles? Curious where this lands here.
Or are you going to see how many participants are left standing?
We've had one answer so far. Yeah. Okay.
That's winning out.
Well, we'll have to aggregate the responses here. I think we're about out of time. I want to thank you, Rob and Steve. You both were great, and appreciate your time today and your participation. And thank everybody for participating and joining us. And I'll throw it back over to Mark for some closing remarks.
Thanks, Jake. And I want to thank all of our panelists today, including Rob and Steve and Jake, for giving us a very interesting and informative program. I want to thank the folks at Convene and Sean Ashanti for the technology involved. I'd like to thank the folks at Riley Safer Homes in Consilla, particularly Therese Squillo and Addie Ortiz for making today possible, and a special thanks to Jake Kahn for getting this all organized. To our attendees, right below the live screen here, you'll find the CLE forms, evaluation forms, links to the written materials for both of our panels. This website has been archived and will be on the Riley Safer website. And to all of our attendees, I want to say thank you for joining us today. I hope we see you next year. Thank you. Take care.